This is Talking Asset Management with KPMG, and today's episode is about transfer pricing and credit.
Welcome, everyone, and thank you for joining our Talking Asset Management podcast series where we focus on credit funds and credit fund issues. And today I'm joined by two of my partners, Vinay Kapoor, who is a EBS partner who focuses on transfer pricing in particular, and Crystal Casillas, who is a BTS asset management partner like myself, who also focuses a lot on credit. So why don't we just get into it? Vinay, I'll lob an easy one out for you. Why is transfer pricing important when it comes to credit funds?
Thank you, Pat. We've had increased globalization in the asset management industry worldwide. We see significant capital inflows into the U.S. credit markets from foreign investors. When these foreign investors, as well as certain tax-exempt investors, invest in the U.S. credit markets, for certain types of credit investments, they really come through a C corporation or a blocker corporation, as some people call it. And they do so for various reasons, tax reasons, in order to, invest efficiently in the U.S. And when they invest through these U.S. corporations are typically capitalized with equity and a shareholder loan. The shareholder loan is considered intercompany financing. And under the U.S. transfer pricing rules, these shareholder loans need to be analyzed to ensure that the debt to equity ratio is supportable in the market and that the interest rate is arm's length. So that's really where we spend a lot of our time in transfer pricing in the credit space, is looking at shareholder loans to C corporations or blocker corporations.
It's interesting, Crystal. It's in practice, historically, how have people sort of approached transfer pricing when it comes to these intercompany type of loans?
Yeah, I mean, when you think of credit, you do a lot of debt, and they are thinking about blocking ECI, effectively connected income, from trade or business. And these blockers are a good way to do that, but sometimes they just do it, right? And they don't always think about, this actually does need to be arm's length, and the assets that underlie it matter. The leverage that underlie your investment matter. And so that's when we reach out to folks like Vinay, who can really help us make sure that is arm's length and falls within the safe harbor, and document that up rather than just going, I see in this particular industry about a 7% interest rate. It needs to be much more well-vetted than that.
What I've seen, if you sort of look at the issues in credit, a lot of it was focused on federal for a while, and we've done a bunch of podcast series on different types of structures and issues on the federal side. But SALT has gotten much more important, right? But now, Vinay, you're sitting out there saying, "Whoa, don't forget about me." And it's because, there's a lot of activity now around these type of intercompany type of loans, these leveraged loans, right?
Exactly, Pat. And in fact, I've been doing this work for a number of years across the asset management industry. And more recently, as credit funds have become very popular, a lot of the shareholder loans are in the credit space. But what we have seen is that not only has the IRS gotten a lot more active in auditing and reviewing these sorts of arrangements, but investors are getting very sophisticated too. In fact, it is not uncommon for a sophisticated investor investing in a credit fund to ask the manager, "Do you have a transfer pricing study to support the shareholder loan?" Right? So it's the pull is being driven not only by the investment managers, but also by the limited partners coming into these funds who are wanting to make sure that their tax profile will be respected going forward.
Is also getting more sophisticated in terms of looking at these and auditing these. I think, Vinay, you've had some experience with that as well.
That's right, Crystal. These sorts of shareholder loans are not only going through exam, but significant audit scrutiny. We've been involved in a number of such cases involving shareholder loans where the IRS has been looking primarily at the interest rate, but also at the amount or magnitude of the debt, which gets to the debt equity ratio. And the one key lesson I've learned from all of this is make sure you have your story out there for the IRS to review. If you do not have a transfer pricing study, which is you're not telling the IRS your story, the IRS is likely to interpret facts their own way, which may not lead to a happy resolution at the end. So it's very important, I think, at the outset, when you're doing these shareholder loans, make sure you do a rigorous study that lays out the facts, that lays out why you're analyzing the shareholder loan in a particular way, and providing the support that the IRS would be looking for.
We're not saying anyone's doing anything wrong. What we're saying is that there's a heightened awareness on this. And so from our perspective, we're saying, hey, take the time to do a robust transfer pricing study on your shareholder loans, just so you can avoid less scrutiny, right? Isn't that sort of what we're saying?
That's exactly right, Pat. And I think, one thing is worth mentioning. A lot of managers in the credit space are very sophisticated managers, right? They have a lot of experience. They may actually be making loans to third parties that are very similar to the shareholder loan. So I've heard, when in working with clients, when they say, well, I have experience making these sorts of loans. I have all sorts of data that I can show the IRS when they come in. And that's true. They know the market. They probably can price a shareholder loan very well. But the IRS takes a slightly different perspective. The IRS is very concerned about quote unquote bias in the data that is being provided to them. So they have kind of a rigorous process that you really need to go through to show that the comparables that you select, for instance, to benchmark the interest rates, was selected in a process that is unbiased, that leads to an unbiased conclusion. And so while the market information our clients have is very important, and I use that in supporting my analysis, the analysis really has to stand on its own and be derived from a process that the IRS has bought into and has put forth.
Yeah, I was going to jump to Crystal for something, but now that you did that, I guess maybe just to add on to that, what are some of the common mistakes or common issues you find when someone brings you in maybe after the fact? What are things that people who are listening to this can learn from, okay, I'm going to pay attention, but what are the common mistakes?
So there's several things that we see when we come in after the fact to review maybe a study that had been done before or internal support that had been put forward, put in place, is that when analyzing the shareholder loan, the focus is on the blocker corporation and the capitalization of the blocker corporation. And kind of forgetting about any sort of underlying leverage that might be at the asset level. Because oftentimes, when you're making these credit investments, you might have a subscription line or some other sort of third-party financing. You really have to look at the blocker corporation and the underlying assets or investments as a consolidated whole to look at how much leverage there is in the system as a whole, apart from the shareholder loan. Some of the other things that we see is not incorporating enough flexibility into the shareholder loan terms. We all know that a lot of these funds that we see out there, they have extension options. It's a 7-year fund with, say, 2 1-year extensions. Does your shareholder loan allow the flexibility for the loan to be extended? And what sort of additional interest do you pay for that extension? Or the ability to pick the loan, or meaning to accrue the interest. You often see mismatches in cash flows, inflows and outflows from the blocker. And to account for that, it's usually helpful to have a pick feature or a feature to prepay the loan with no premiums, right? So those are some of the things, around loan structuring. The other thing that I see a lot of is not structuring the shareholder loan to account for future capital calls, right? You're not generally just doing one capital call and that's it, right? Usually you start a fund, you have a soft close, you call some capital, you get some more investors in, you call more capital. You have that whole investment period, which may be a 2 to 3 year period approximately. And in many cases, you can structure the shareholder loan. Not in all cases, but in many cases, you can structure the shareholder loan so that you only have to do one study up front rather than a new study every time you call a new loan. Because if you structure it so that every capital call leads to a new shareholder loan, technically, under the IRS rules, you are required to do a new transfer pricing study each time, which can get quite onerous. So structuring the shareholder loan up front is really an important consideration that we find that clients sometimes don't pay enough attention to. And lastly, and very importantly, is it is not uncommon for us to see an analysis of a shareholder loan in the credit space that treats a shareholder loan as a typical corporate loan. there are significant differences between shareholder loans made to a blocker corporation that invests in credit funds versus a typical corporate cash flow loan. And that's another topic that we can spend a few minutes on if you needed to.
Well, we are not going to go down that path. So everyone knows on this phone call, the three of us are actually on video so we can see each other. And Crystal has her hand up. She really wants to say something, so we are going to get Crystal in.
I didn't want to interrupt Vinay, but he mentioned future capital calls. But on that front, something that I often see is a manager will set up a fund and they'll start to kind of diverge in their assets or their investments, or they obtain something below that's additional debt, has additional liabilities, different asset class, and so those are good points to also raise when new transfer pricing studies may need to be evaluated and done.
No, that's a great point, Crystal, which is shareholder loans. The transfer pricing of shareholder loans is like any other transfer pricing. It's not like you put it in place and just let it lie. You have to continually do some sort of upkeep to make sure there be no material changes in facts that you need to account for, which might require you to redo the study, or material changes in the market environment like we're seeing today, where interest rates are elevated and very volatile. There may be an opportunity to refinance existing shareholder loans that might leave you in a better position. So that it's kind of a living study rather than a one-time done all study.
Well, thank you both for your time. This was great. What I will say to everyone who's listening, when you look at the activity that's taking place right now from audits, whether they're state, federal, foreign audits, we are seeing transfer pricing really being a key area of focus. So please find the time to review your transfer pricing and make sure they're up to date. And if there's any questions, feel free to reach out. But otherwise, thank you very much for joining. And we will have a number of these other credit-focused podcasts coming shortly. Take care and thank you.
Thanks for listening to Talking Asset Management with KPMG. Be sure to subscribe to this series and visit read.kpmg.us/talking-asset-management for more information.